good morning, and welcome to another live technical analysis. So, we're going to be jumping straight into the charts with the euro against the dollar. So, about a few minutes ago, we had the Eurozone's preliminary CPI rates and GDP rates come out, with the CPI rates coming in lower than expected, if I'm not mistaken, at zero point 0.1 versus the expected zero point 0.3, and the GDP rate coming in at minus zero point 0.1, implying a contraction in the Eurozone's economy. The lower than expected CPI rates, as you can see, is formed by this bearish 4-hour candle. If we move into the 5-minute time frame, we're probably going to see the bearish candle. Yes, we can. On the 15-minute as well. On an hourly, yes, and on a 4-hour. So essentially, the lower than expected CPI rates may be weakening the ECB's resolve to perhaps hike or even remaining in a pause. Now, the contraction in GDP may be more concerning than the lower than expected CPI rates. On a personal level, following Germany's CPI rates coming in lower than expected, and despite their GDP rate coming in slightly higher than expected, the CPI rates, based on that, I would have expected, as occurred, to come in lower than expected. So we saw that the euro against the dollar was moving in an upwards fashion formed by this bullish 4-hour candle. But following the release of the CPI rates and the GDP rate for the Eurozone, and we're noting that this is the preliminary release as well, it appears to be moving in a downwards fashion. So we're just going to be clearing our chart and replacing our support and resistance levels. The technical analysis in this particular one will be in English. So we had a sideways moving channel. We had an upwards moving trend line as well, formed by this bullish candle. We could have had a secondary one being formed here. On a smaller time period, we could have had perhaps another upwards moving trend line, but I'd rather keep the two trend lines from a more macro perspective. And personally, I'd rather use the opening and closing of the candles. So it was moving in a sideways fashion, broke above, came back lower, moved higher, but is now coming back down following the release of the CPI rates. So let's just place our support and resistance levels once again. Let's zoom in. So we could have 1.0564 as S1. $1.0565 for S1. Nope. Small mistake. There we go. We'll be changing our labels as well as we go along. So for support 2, I'd be taking where my upwards moving trend line coincides with the closing of this bearish candle and the opening of this bullish candle. This for me is a confirmation that there is heavy support at this point in time, also validated by the upwards moving trend line, which was formed following the formation of this bearish and bullish candle. Therefore, I would expect that when it comes back down to S2, it may meet some resistance. So 1.025 for S2. But it actually might be, it's far too close, it's about 40 pips. So this might actually be a valid support level. But from a more macro perspective, it might be prudent for us to simply bring it in slightly lower. We know that the Fed's interest rate decision is due out tomorrow. So there is a possibility for a market reaction to wipe out S1, wiping out our previous S2, which we had placed with the upwards moving trend line, and then moving towards S2, which we're placing as of now, 1.049. Actually, we can put 1.0500. Yes, we can. So this would be S2. But it might need some slight editing. So I'm taking, when this bearish candle came back down, the wick touched upon our upwards moving trend line before moving higher. Once again, this was from after the formation of these candles. And then you had a very strong market reaction to the upwards direction. So this could have been taking out market participants, gaining liquidity, and then moving higher. So this would be more valid rather than simply taking this previous swing low, for example. Had I taken this point, which technically would have still been valid in terms of a distance between S1 and S2, we would have ignored this candle and this candle here, this formation here, and that formation there. We could actually even take that point as well. So why are we placing numerous support levels? Well, it depends on your trading style. It depends on your personality and depends on what you're looking for. No technical analyst has the exact same support and resistance level. Perhaps around the same figures, yes, but it depends on what you're looking for. So I could make the case for either of these support and resistance levels. Case one being 1.0505. If we simply round this up to the nearest uh, 0.5, well, no, no. Rounding it up, it would have to be 1.054, not even 5. And even that's slightly neglecting some of the candles, but in order for it to be a big figure, we can put 1.0504. So you have two support levels, S1, excuse me, S2, or an alternative to S2. One could argue that this might be more valid since you have multiple touches in terms of the opening and closing candles, whereas this, there was a more of a significant move. So what we could do, we could add an indicator that shows us the volume. And I'd rather not use that. Indicators, we can go to volumes, accumulation distribution, unbalanced volume. Perhaps. Just make this slightly easier for the eye. You could use an indicator or simply using the volume given to us on our charts. So let's check out the volume at this point in time, at this candle. Let's just mark it on our chart as well. So let's take a let's take a circle right here. So this is volume one for our bearish and bullish candle. Now let's find the volume for our alternative support at 1.0504. So at this point, it would have been around here, lower volume as well, lower than this bullish and bearish candle. And once again, so on most instances, we're seeing that the volume accumulated on this bullish candle was larger than the previous support, excuse me, the previous candles that we had mentioned before. So I would take our S2 as being 1.0495, but it's slightly below. So I'd like it to touch 1.0496 as S2. Now, if it does come back down, there's nothing to say that it won't meet support at this level that we had placed before. The reasoning as behind this S2 is that it might meet more significant support at this point. There's nothing to say that you couldn't perhaps, in theory, enter a position or perhaps finding an optimal entry between these two levels. Perhaps reaching down, perhaps it could even be a wick that touches up on RS2 before moving slightly higher in terms of a market reaction. And then for S3, it would have been nicer and easier if I had simply placed S3 at the lower end of this sideways moving channel. Simply placed here, and then S1, S2, S3. But given that we're placing S2 at this point in time, which was actually validated by this bearish candle, which I'm just seeing now, S3 could not go at this point. Why? 36 pips. As most of you probably know, 36 pips is absolutely nothing. Just take this 4-hour candle here. 69 pips. So if I put S3 at this point, which is about 30 pips, a simple move, such as this bullish candle, would have wiped it out. And then what would you have done? You would be scrambling to find the next support level for S3. So we're just giving ourselves some space. There's nothing to say that it won't meet some resistance or support in between. But let's find our new support level. I'll show you what I'm looking at in just a moment. Had this been slightly bigger, it would have been perfect. Why? There's a bearish candle that made a wick, so it took out some liquidity and moved higher. Validated, didn't almost being validated by this bearish candle, but it had a swing high here. But once again, as we said before, it's far too close. So let's give ourselves some space. But this would be too far away. We need to find something that's in between, something that's not too close to S2, but yet not too far from S2. Because it's easy for me to say, look, there's support here, and there's support here. Well, the difference between these two is 257 pips. That's a significant difference. We're not talking in terms of monthly outlook. We're talking about perhaps at the most a weekly. Optimal, though, would be the next few days or so. So, simply put, it's far too big of a gap. And now the hunt continues for support at S3. Placed here, too close. We could take this prior high formed in the middle of this order block as well. And I think this could actually coincide with 100 pips, 85, 86 pips. Let's see if this is valid though. Since we're not taking prior swing high and we're using this, let's see how the market reacted when it came back down. You can see that the wick moved below, but it was validated on 2 occasions. So after this 4-hour candle finished, it opened, it moved lower, validating support, and then moved higher once again. So this would be a valid support level, but with a pinch of salt. So you have S1, S2, and S3. Let's just fix up the numbers a little bit. 0.417. I could put it at 0.415. And then once again, if we're rounding up our support levels, we must always make sure that they are coinciding with what we had seen before. No. As you can see, it's not. So 0.4120. 0.4120 is much more appropriate for our support level at S3. And then let's just fix up our text labels as well. We're going to be looking at the Aussie against the dollar as well. And the reasoning behind that is, firstly, China's PMI figures. China's PMI figures are actually quite bad. Get to that in just a moment. Let's just finish off with our our euro against the US dollar chart. 0.496. 0.496. And then for support and, for resistance, swing high, opening and closing. Could have placed it slightly lower, but I think this is slightly more valid. So this would be in red. No, let's not edit the Bollinger Bands. 1.067. Could it be 1.0680? No. 1.0678. So that would be our resistance level at R1. And then we'd be placing R2. Beautiful order block as well. Resistance at the top end of that. So 1.0735. Let's just measure the distance as well. 55 pips. If it coincides with S1 and S2, perhaps too close. Would have been very nice though for a resistance level, but it's still too close. Then let's check a bit far away. And then we're taking this high. Accumulation attempted to break above, failed to break, and then moved lower, validating as R2. 1.0759. If you'd like to see something in particular, feel free to ask in the chat. 1.0759. And then for R3, order block, and it's a bit too far between R2, but based on the data that we have, it's more appropriate to allow this distance. The reason as to why we did not do the same with the support levels is that we could justify a support level that was perhaps slightly closer, but with the resistance levels, we're ignoring this, which was validating our downwards moving trend line. We came back up here to a swing high, which was tried to be broken multiple times and failed. And then far too close, and we're neglecting this swing low here. And then we're neglecting this move higher. So in this case, our R3 will be slightly further away, 1.0860. Once again, not validated. I wanted to touch the closing of this bullish and the opening of the bearish candles, respectively. 1.0863. Much better. So let's just put this into perspective. And let's just fix up our labels as well. Feel free to chart at home as well, so you can see it from a visual perspective. So we have R3. Then with R2, we've already fixed up our text label. And then for R1, 1.06780. You can use simply 78. And then for support, 1.0565. About 76 pips. And then between this one is 2. Support levels are a bit closer than I'd like them to be, but still valid. But for a bearish outlook, it would need to break below S1. Now, if we're placing our support or resistance levels slightly closer than each other, so for example, for a bullish outlook, it would simply need to break above R1, and then the next potential target could be R2. For a bearish outlook, it would have to break below S1 and then breaking below S2 to be validated as a bearish momentum. Simply breaking below S1 may not cut it. Why? It's at the mid-range of the Bollinger Bands. This could even be considered a market correction to lower ground, since at the upper range of the Bollinger Bands coming lower before moving higher. But based on the CPI and GDP rates, the preliminary rates for the Eurozone, I would expect the pair to move in a downwards trajectory, perhaps moving towards S1. Now we're going to be looking at the dollar against the Japanese yen. This may be interesting following that the BOJ's interest rate decision was taken earlier on today. The bank remained on hold, and I don't think anyone was expecting them to hike anyways. The market participants and the predominant industry players were expecting the bank to remain on hold, as they did. What was interesting was their commitment again to their ultra loose monetary policy. They're also allowing their 10-year government bond yield to fluctuate near 1%. Essentially, they're saying we're allowing more ultra loose monetary policy, which may have facilitated, and probably appears to have done so, this rise above the 150 level. The candle that we had mentioned before was potential government intervention. The question now is, having broken above R1, this is resistance now turns support. The thing is, how far are they going to let the pair go? Will the government intervene, as we had seen previously, or will be allowed to move even higher? Personally, I think they will intervene at around perhaps R2. 151 may be a limit they do not want to be breached, but this is all pure speculation. Temporarily, a bullish outlook for the pair, but from a more macro perspective, I would switch to a bearish outlook. This is resistance turn support, 150. S1, 50, and then as prior S1 becomes S2 and so forth. And then 147.50 becomes S3. The chart is slightly compact, so I'll be expanding it in just a moment so that we can get a clearer view in terms of the 4-hour. Zoom out. It broke below our upwards moving trend line. It could have been considered a breakup, but then moved higher. So essentially, correction. What we could draw, let's just see where very long-term upwards moving trend line actually coincide nicely here. But from a shorter time frame, we would have drawn upwards moving trend line from this point. This could have been a second trend line, and then this could have been a third. In the event that the pair breaks below this particular trend line, which was made at the 148.87 S2 level now, I would immediately switch to a bearish outlook. Why? You have three trend lines broken on one occasion, broken a second, and on the third time, there may be a bearish market sentiment forming. So I would keep an eye out on this third trend line crossing on this swing low. And now we have R1, and then we could have R2, and we now need to find resistance level for R3. And so the hunt begins for R3, which I do not think we will find. We'll have to place it in ourselves. Yep. So how do we decide which level will be R3 since we have no data available to us? Simply put, we'll measure the distance between the resistance levels, 153 pips, roughly. $52, and then 150. So we could put it at 155. That is a big figure as well. Could be validated, but we will see. This is pure speculation. But we have seen that market participants tend to favor round figures, especially in the event that we do not have prior historical data. That might be interesting to look out for. But for a more short-term view, perhaps a bullish outlook on the pair. But from a more macro perspective, as we said before, a bearish outlook on the pair. So this would be R3. And then 55. We're going to be moving on to the Aussie. So the Australian dollar against the US dollar. Let's move these duplicate figures. It appears to be moving in a sideways fashion. Now, China's PMI figures came in lower than expected. In particular, their manufacturing PMI figure actually dropped down to contractionary figures. What does that mean? It dropped below 50, which may indicate that the manufacturing industry is contracting. So, why does it impact the Aussie? Well, in a nutshell, the Australian exporting economy is heavily dependent on the Chinese economy importing their goods. So, how do the manufacturing PMI figures impact this? Well, if you are producing slash manufacturing less, then that means you may require less of a particular good, perhaps or a resource that Australia is providing in terms of their mining industry. So if you need less, you import less. If you import less, that means there's less demand for Australian exports. If there's less demand for Australian exports, that could weigh on the Australian dollar as it becomes weaker. It will be interesting to see China's Kaijing preliminary figures, which are due out in tomorrow's Asian session. Based on what we've seen, I would expect them to come in lower than expected, which could further weigh on the Aussie. Now, something that we have not mentioned is that the Fed's interest rate decision is due tomorrow. We're going to be discussing that as well in tomorrow's live technical analysis. But from today, if I'm not mistaken, about 100% of market participants are expecting the Fed to remain on hold. Personally, I think that the Fed may hike. It's a very interesting scenario. And why am I expecting them to hike? I think that the inflationary pressures are still in the economy. I believe that they still have issues with inflation. I think that the Cleveland inflation projection figures remaining stable for the foreseeable future may be concerning for Cleveland Fed President Messer, which could amp up the hawkish rhetoric. But if they do remain on pause, which is a very likely scenario, as I've said before, I would expect it to have some hawkish rhetoric inside of it. So, in terms of their forward guidance being slightly hawkish, which could appreciate the US dollar, and that could weigh on the pairs which are denominated. So, a weaker euro, weaker pound, stronger dollar, so weaker Japanese yen, weaker Aussie, weaker loonie. But in terms of the Australian dollar, moving in a sideways fashion, we're just going to be extending our sideways moving channel. Okay. Sideways between our support and resistance levels. Switch this color to black so that you can easily see it as well. There we go. Small market correction, broke above. Now is moving in between the support level S1 and resistance level of R1. So sideways fashion for the Aussie up until tomorrow's Kaijing Services PMI figures. What we could also see is the narrowing of the Bollinger Bands, which imply low market volatility and as such, up until the Kaijing services, not services, Kaijing figures, be interesting to look at. Oil, predominantly, and in most of the discussions, is oil. So why do we care about oil? Well, we need oil. It's moving lower. There's less fears of a wider conflict in the Middle East between Israel and its neighbors. It appears to be confined in Israel at this point in time. We're seeing an easing of the rhetoric of a potential war between numerous countries against Israel. Therefore, it may be easing pressures on oil. What is interesting, though, was a story by Bloomberg that Houthi rebels in Yemen attacked Saudi Arabian forces after they tried launching a missile towards Israel. So, why do we care? Why is that of importance? If you have further instability between on the border of Saudi Arabia and Yemen, it could actually provide support for oil prices. If the trade routes between Saudi and Europe is placed in danger, perhaps by the targeting of vessels or explosions in oil fields, perhaps by targeted attacks, etc., it could actually boost the price of oil. So it is a very significant development, in my opinion, which is worth monitoring and keeping a close eye on. So we had R1, which was broken below, and is support and resistance at the 84.50 level. So R2, R1. But from a technical view, it would be a bearish outlook, at least for now. But given that the region is still very volatile, there are still concern about how this is going to play out. If and if we do say that it's moving in a downward fashion today, it could change within the next hour or so if there are attacks on the oil infrastructure in Saudi or the UAE or Qatar, or simply put, there's an escalation of conflicts between in the Middle East, essentially. So even if we do say it's moving in downward fashion now, that could easily change. So I'd be playing more in terms of the support and resistance levels, monitoring what's going on a daily basis, perhaps even on an hourly time frame, not in terms of the chart, in terms of news articles, to see what is going on, as it could change from a moment's notice. Even now that we're talking, it could simply swing up, break above R1 and R2, and move towards R3 if something significant happens. But for now, from a technical basis, it appears to be moving downwards fashion, broke below support now to resistance at R1, aiming for S1, bearish outlook for S2. I say near 50 could be a sideways fashion, but I think it's simply a bouncing off the lower end of the Bollinger Bands, perhaps the mid range, before moving in a downwards fashion. We're going to be looking at gold as well. Let's see, gold. Let's move the duplicated text labels. Now, we have R1 set at 2008. Actually, bring it slightly lower. 2005. So 2005. And then for R2, 2050. My bad. 2050. And then R3, 2077. Actually, that's the wick. 2077 it is. I'm guessing it's the wick that we're gonna. There we go. So that's why it's close to R2. Now, in consideration and when compared to oil, gold appears to be faring much better. In the Middle East, oil is essentially liquid gold, and in terms of the world. But for the precious metal, in particular gold, since it is the precious metal, there are numerous other factors that may have to be taken into account. You have escalation of tensions between China and its neighbors. A global recession could fuel inflows into gold, and appears to be weathering the storm of the pressure of oil much better. So you can see oil moved stronger down trajectory. There's less of a reaction on gold. So, sort of safe haven, faring much better. We would not switch to a bearish outlook on gold from a technical basis yet, since it's bounced off from the mid range of the Bollinger Band and is still validating our upward moving trend line. But for a bullish outlook, it would need to break above R1. For a bearish outlook, breaking below S1, moving towards S2. If we see an easing of tensions in the Middle East, it could weigh on gold. The thing is, with more tensions rising in terms of military escalations and perhaps attacks, gold might fare better than oil in terms of a bullish momentum. So we maintain the opinion that it might move slightly sideways. I don't think I'd switch for a bearish outlook on gold as of yet, as we've done on oil. I think gold might move slightly more of a sideways fashion, waiting up until the Fed's interest rate decision due out tomorrow. And I think we might see one last pair. As a matter of fact, why not do a stock? Let's see what we can place up here. BNP Paribas, Deutsche Bank, Banco Santander. Tesla might be interesting. So Tesla actually reached levels last seen in May of this year, 5-month lows, broke below. Ooh. There is a gap being formed here, so this could be a breakaway gap. Let's just mark this on our charts as well. Rectangle shape. I'm using the wick, not the body of the candle, because there. So this is liquidity that might be seeked in the future by the market. Finding some support at this two, which was 198. It's actually dropped pretty far below. So for S1, perhaps we could use. Note how I'm aligning this bearish candle with these three candles here, and then this fourth. So this would be support at S1. Give it some space to move. 193.10 for S1. And then we'd keep our previous S3, which was 165, as S2. And then for S3, $144.88. And let's just, this gap was filled at this point in time. Some left, but nonetheless, it was reached. So this would be S3. And then for R1, 225. And then we bring I'd want to bring R2, which is quite close since this gap was formed, and might be a breakaway gap as well. So this maybe is of importance, I should say. 242, but it's far too close to R1. So for a bullish outlook, it need to break above R2 as well and move towards R3. Simply breaking above R1 would not cut it. For a bullish outlook, it would need to move towards R3, which is at the 266 level. The only reason I'm placing R2 is due to the fact that there is a significant gap that was formed and might be filled. So you might actually, the stock might actually meet some resistance at this point, which is why we're placing it in now. 42 and then turn 25. So S1, S2, and S3 are side below 50 and actually below 30, implying a strong bearish market sentiment. Could correct slightly higher, perhaps up to the opening of the bearish candle before moving lower, breaking below S1, moving towards S2, since it could also be considered to be oversold since it's below 30. But bearish outlook on Tesla, at least for now. For the rest of the week, I will be hosting the live technical analysis on the daily basis. So until then, have a nice day, and I'll see you tomorrow.
name is Christina and welcome to another video. This time we will talk about liquidity and volatility in Forex. Let's start with liquidity. So, what is Forex liquidity? Liquidity in the Forex market refers to the ability of a currency pair to be bought or sold without major changes on its exchange rate. Simply put, when you can easily buy or sell a pair, it is considered highly liquid. In fact, the amount of money that flows in the market as well as the number of traders that want to buy a certain asset determine the level of liquidity. When there is a decrease in liquidity, there are fluctuations in the quotations. During such periods, buy and sell order volumes can change many times. Now, which are considered the most liquid pairs? Euro USD, USD CAD, GBP USD, USD JPY, AUS USD, GBP JPY, Euro JPY, USD CHF, and ZD USD are some of the most liquid pairs. They have the highest available trading volumes. However, as markets open and close across the globe, their liquidity can change throughout trading hours. Did you know that the daily Forex trading volume has reached $6.6 trillion, making the Forex market the most liquid worldwide? You can be confident that in such a market, you will always be able to buy or sell an asset, as there will always be someone available and willing to buy or sell. This is what liquidity is in a nutshell. Stay tuned for part 2, where we will talk about volatility in Forex. Thank you for watching.
So hi everyone, welcome to our Trade Management Series webinar. So this is brought to you by Everest Fortune Group in collaboration with IronFX. So today's first part of our series will be on scalping. Before we get started, just a risk warning. Okay, Michael is a scalper most of the time. That's cool. I do like scalping as well. If I don't have that much time to sit in front of the computer, I think it's a good strategy as well. So we'll go through 3 powerful scalping strategies at the end of the webinar. So you guys can keep a lookout for that. Okay, so a risk warning, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda. We'll just do a brief intro to scalping for those of you guys who aren't familiar with it. And then we'll take a look at Fibonacci confluence and where you should place your stop loss and take profit. And then stay tuned to the end to where we'll go through 3 powerful scalping strategies. So I'm your host for today. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. And if you guys were curious, you can feel free to connect with me on LinkedIn as well. It's just my name. Okay, so what is scalping? So it's a fast-paced, exciting, and mind-rattling all at once So basically, it's where you take trades for short time periods. So you grab very small amount of pips and you risk very small amount of pips as well. So you're basically taking advantage of market volatility in this case. And the time frame, if you guys were wondering, for scalping is normally on the shorter side, just so that you can catch all of the market volatility, the market movements. So it's briefly, we think that 1 minute to 5 minutes is a little bit too short. So because the time frame is so small, it can get really your charts can get really noisy and it might be a little bit difficult to catch all of the movements and conduct your analysis because of the constant movements. So we like to stick with 15 minutes to about 1 hour for scalping. Okay, so why scalp? There are known unknowns. Okay, so what we mean by this is a good example would be if the NFP is coming out tomorrow, for example. You know that the event is coming, but the outcome is unknown. So these events can really mess up a trade. So in this case, you would use scalping so that you can avoid any um, any known unknowns, basically. Okay, and locus of control. So let's use weather forecast, for example. So if there's a 1 hour forecast versus a 1 week forecast, you are likely to have more control over what's happening in the next 1 hour versus over the next 1 week. And new opportunities every time you open the chart. So market moves really fast on the M30 and H1. So there are new patterns every couple of hours. Okay, so how much time do you need to scalp? Time commitment wise, you basically have to find the trade and set the trade management. We'll talk a little bit about stop loss techniques and stuff like that later on. But that's basically all you need to do. Set the trade, make sure that your risk management strategies are intact, and that's it, you're done. And then you just have to review it every few hours. So the holding time is typically from a few seconds to a few hours, depending on your own strategy. So our recommended time to trade, or rather the different amounts of time that you have to put in, will be 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So it's not too time consuming. And it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so this talks about your trading stop loss, the different stop loss techniques, which we will briefly talk about later on in our slides. How much leverage do you need to scalp? So this is typically quite a high leverage strategy. So it's about 1 to 100 onwards. And you normally would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. That's just our recommended amount. Of course, it's completely up to you. Decent leverage of at least 1 to 100 is preferred, but not necessary. Um, so if we're talking about what exactly is leverage, so if we take, for example, a trader who deposits $1,000, so they can use $100,000 with a 100 to 1 leverage in the market. So this can greatly magnify your returns, but also your losses. And this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So what this means is that with an account size of maybe $1,000, right? Only $10, or which is 1% of 1,000, should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their 1,000 into 2,000 quickly. Okay, so yeah, so if you can do it with $250, then you can do it with 2,500 and 25,000. But definitely don't rush into scaling up. Okay, now let's get into the three powerful scalping strategies first. Okay, so firstly, we have the horizontal pullback strategy. So if you guys were here for our recent support and resistance series on our webinars, yeah, this would be familiar with you. Next would be our Fibonacci retracement strategy. So it's pretty straightforward. You're basically using Fibonacci retracement to see where prices will retrace towards. And lastly, we have the 90 tick strategy, or what we call Fibonacci extensions. So let's get into these now. Okay, we're going to start with horizontal pullback strategy. So a horizontal pullback basically means that we are expecting price to pull back or retrace back to that level. So in this example, we see that we have a multiple swing high resistance, this red area. Okay, we have three swing highs that all line up along the same area. And then price surpasses this resistance. So it breaks out of it. And since it's breaking out of it, we are expecting price to return back to that level. If you're wondering why we can expect price to return to this level, it's because of this multiple swing high resistance. So basically, the more number of swing highs or swing lows, if we're talking about support, if we have more swings that line up in the same area, price is likely to return and respect that area again. Okay. So in this case, since it's a resistance at first, we are now expecting it to become a support. So from a resistance, once price surpasses it, now we call this a pullback support level. Okay, if we are looking at a multiple swing low support, same thing when price breaks past the support level, we're expecting price to retrace back to that same level. Okay, in this case, we are calling it a resistance. Okay, let me know in the chat if it's a little bit confusing. Okay, but here's a couple more examples. So the key basically to scalping is making sure that you have a bunch of indicators and a bunch of graphical analysis that all supports your analysis. So if in this case we have price moving below the Ichimoku cloud, so that's a bearish signal. Okay, and price has also broken out of this swing low support. Okay, so we're expecting it to return back to that level. And you can see that's exactly what it did here. Okay. Next, let's talk about the Fibonacci retracement strategy. So firstly, this is an example of an insignificant swing. So just a reminder that these swings should not be used as Fibonacci points. Okay, because the swing highs and the swing lows are too insignificant. Instead, this is what you should be looking for. Really clear troughs and peaks and very clear market movement. So this forms the basis of all starting, middle, and ending points when we're using Fibonacci levels. Okay, so you shouldn't pick swing highs and lows that are not significant. meaning that they need to have a relatively big move before or after it. So as a rule of thumb, you can use at least 15 bars before or after to see if they are really significant swings or not. Okay, another reminder. Okay, when you're drawing Fibonacci retracements, projections, extensions, or expansions, whichever you are doing, there's one important rule that you have to follow, and it's that your Fibonacci line must follow price structure. So your trend line can deviate from structure, but not by too much. So if you look at this example here, you can see that price doesn't really follow price structure over here. Okay, so this is what we've drawn is the shape of the price, and our Fibonacci just cuts through the shape entirely. So the trend line deviates from price structure by too much in this case. Okay. Next is our strategy. So the tool we're using here is Fibonacci retracement, which you can get from, it's the same tool that's on TradingView as well as MT4. So Fibonacci retracement percentage, excuse me. So for the percentages that we use for retracement, we use mainly the 5. So it's 23.6, 38.2, 50%, 61.8, as well as 78.6. So those are the levels that we use for Fibonacci retracement. Okay, so let's do a bit of a recap first. When you're picking the starting point, so basically your entry or your support or resistance levels, there are some rules that you have to follow. Firstly, we want to check if there's a swing high or low, pullback, or overlap level. So we talked about pullback already. Overlap, if you weren't here for our support and resistance, overlap basically means that there is a swing low as well as a swing high that are at the same level. Okay, that's what we call an overlap. So secondly, we want to make sure that our starting point goes back as far as possible. And you want to make sure that it doesn't intersect too many bodies of candlesticks, but the wicks are fine. So you see in this case, it's just the wicks, so it's an okay thumb. But we are preferably looking for really significant swings like over here. Okay. Another example here, we're cutting too many bodies of candlesticks over here, which is why it's not um preferred. If you look at the green thumbs, we have really nice multiple swing highs that line up nicely, as well as overlap levels once the swing low touches that same level. Okay, and we see here as well another swing high here. Okay, once again, cutting too many bodies of candlesticks over here, which is what we want to avoid. So in this case, in order to rectify the situation, you can actually just stop your support level over here. So it's a support level because price has already surpassed this resistance, thus making it a pullback support because we're expecting price to pull back or retrace back to this level. Okay, so we talked about the pullback already, so I'm just gonna really quickly skim through this. I'm just gonna show you guys the GIFs. Yeah, and show you guys how we look for pullback support and resistance levels. Okay, so here we are making use of two levels, or rather two Fibonacci trend lines. Okay, we have this really long one here and one small one here. And then we highlighted the area where we are expecting price to retrace off of. Okay, so the 61.8 and the 38.2 that we see here lines up nicely with this swing low. Okay, so a pro tip is that when a pullback support level lines up with a Fibonacci level, in this case we have two Fibonacci levels, so it's a very powerful level. Um, okay, because for this webinar we are focusing more on scalping strategies, so the time frames that we're looking at are on the shorter side. So briefly from 15 is like the lowest that we go, 15 to about 1 hour, preferably 30 to 1 hour for scalping. But this strategy can be used for pretty much anything, even if you are a day trader as well. Okay, but yeah, for this webinar, mainly focusing on the shorter time frames. Okay, we looked at these examples earlier. No worries, friend. So we have another example here, the pullback resistance as well. So you can see that we have a significant swing low here, right? And price has surpassed this level. So once price has surpassed it, it then becomes a resistance because we're expecting price to pull back to this level. And you can see that's exactly what it did. If we move on to overlap, so I already briefly mentioned it earlier, but yeah, this GIF basically tells you what an overlap is. It's when there are bulls and bears that are respecting that area, which is why it's an important point to take note of. Similarly, if overlap areas line up with other elements like Fibonacci or graphical elements, then it'll make it even stronger. Okay. Here's another example. I think you guys have kind of gotten it by now. But just another example in case you weren't clear. So this is a pullback resistance first, okay, because price has surpassed the swing low level. So it's surpassed it, we're expecting price to pull back to it. And once price pulls back to it, as we see in this GIF, and reverses off of it, it then becomes an overlap level instead. So the difference is that the difference between pullback and overlap is that once price reverses off of the level, then it becomes an overlap level. Whereas for pullback, we're just looking for price to surpass it. Okay, so now that we know what overlap and pullback levels are, we can combine them to find strong resistance and support levels. So sorry about the text, but here we have a big swing high resistance level. Okay, price surpasses this level and becomes a pullback support. So we expect price to pull back or retrace to this level, the same rate level here. Okay, and in the green arrows, we see price retrace this level and bounce off of it perfectly. Once price bounces off the pullback support, it then becomes an overlap support level. Okay. Combination of pullback and overlap, um, same concept over here. We have two swing high resistance and then a pullback support once price surpasses it. And then we can see price actually respected the area twice in this case. And then once price bounces off of it, it then becomes an overlap support. So actually, even after the first bounce off of this level, it's already an overlap support. Okay, but yeah, we normally when it happens once, you can expect it to happen again. Okay, another example here. In this case, we have many we have prices respecting this 33420 level many times. Okay, with swing low supports, then a pullback resistance, and then it pull back to our resistance 3 times, and then a pullback support, and then back to our support level. Okay. Here's another example. Okay, we have this double swing low support. Price breaks out of it. Okay, we're expecting price to retrace back, but we also have a Fibonacci retracement. You see here 61.8 that lines up with that same level. We also have this 100%, this bigger Fibonacci level here with a 50% Fibonacci level that lines up with the same area. Okay, so this makes it a confluence area, which basically means that you have multiple Fibonacci levels that line up with the same area. Okay, so the reason why that's important is because price is always more likely to be attracted to these areas of confluence. And you can see over here that price was attracted to this area, okay? And then we're expecting it to bounce off again. Okay, like we see over here. Okay, so like I mentioned earlier, we typically want to try and use graphical techniques, indicators, different kinds of um, indicators basically to support your analysis. Okay, here we see that we might have a descending trend line, but you guys know that a valid descending trend line, you need 3 significant touches because 2 is quite common, okay? But we have price moving below the Ichimoku cloud, okay, but it looks like it's breaking out. We also have this almost descending trend line here. Okay, and we also have a Fibonacci retracement where 38.2 lines up with our trend line over here. Okay, and we're also making use of stochastic in this case, where we see that we have 3 swing highs that all line up together. So what this is called is a hidden resistance level. Okay, which basically tells us that price is likely to drop again, like we see over here. Okay, we see it happen twice. Price is making a lower high, okay, but then over here on our stochastic, it's the same resistance level. So we can expect it to happen here as well. Okay, any questions about this? Okay, all good, let's move on. So this is our third strategy, which is the Nike tick strategy. So they also makes use of the Fibonacci retracement tool, okay? But instead, we are using the levels that are more than 100%. So not included here is the 161.8 level as well. So we use 127.2, but we also use 161.8. And this is basically how you use it. Okay, so you have a starting point and an ending point, which is where you draw your Fibonacci trend line. Okay, and the shape that we're looking out for is basically like a Nike tick. So you have you want to make sure that the tail of your tick surpasses 100% of the starting point. Okay. Yeah, and then you see you're projecting where price will reverse off of. So in this case, price reversed off of the 161.8, and then we expected a reversal here. Maybe I'll just show you guys like where you guys can find this on our website. Okay, so you can find it over here. This is just the forexarmy.com. Maybe I'll just pop it into the chat. The Okay, so we have a bunch of trading guides and tools as well. So the tools are mainly for MT4. Just a bunch of indicators, free indicators for you guys to download. Okay. Yeah, support resistance guide and how to draw Fibonacci retracement correctly. So if after this you are still a little bit confused, you can go ahead and look at the extensions. So the extensions is basically what I'm referring to now, the Nike ticks. Okay. Retracements are really basic Fibonacci levels that are important as well to know how to use. Okay, so we have the clear market structures. You can see what to look out for. Yeah, you can go and explore this on your own along with the different confluence areas. Okay, and we'll talk a little bit about this towards the end of our webinar today as well. But yeah, if after this you're a little confused, you can go ahead and check the Forex Army out. Okay, so another example here of a Fibonacci extension. Here it's pretty small. Okay, we have a really small tick here. So you can see the hit um from the 100% to the 0%. That's where I've drawn the trend line. Okay, so I've drawn the trend line and then I'm projecting where it goes. So I see that firstly, I have a swing high resistance here. Okay, so this is where I'm projecting price to go towards, but I see that it's also in line with a 127.2% Fibonacci extension. Okay, so it makes it a significant level, like you can see over here. Hi, Azif. Okay. Yeah, so this is the shape that you want to be looking for basically, with the hit of the tick like this. And you can only use this technique once price has surpassed more than 100%. Okay, but the shape is like a Nike tick. In this case, I'm showing you guys an example of an inverted Nike tick. So the shape that we're looking for, same thing, we're looking for the hit to be shorter than the tail. So the tail has to surpass 100%. Same idea, completely the same. It's just that it's upside down. Okay. In this case, we see that price has surpassed the 127.2%. Okay, so we are expecting price, or rather we're projecting where price will go towards. And in this case, we have price, we have a swing low support that lines up with the 161.8% Fibonacci extension. And you can see that price is reversing off of this level. Okay, so here's how it works, or what we are looking out for when we are using this technique or this strategy. Okay, so we're watching for the reactions off of the 127.2 and 161.8. We're expecting it to reverse off. That's basically what we are doing with this strategy. Okay, notice how we only go in with the Fibonacci extension after price breaks out of the 100% level. Okay, let's move on. So here's another example of the Nike Tick strategy. So the time frames that we recommend for this are 30 minutes, 1 hour, and 4 hours. the entry criteria is that once price breaks out of the 127.2%, stop loss level, okay, these are just recommended areas. So you don't have to follow these closely because charts are completely different. Okay, I don't think you guys can find a chart that looks exactly like this over here. So these are just our recommended areas for you to reference. Okay, so our idea invalidation level is the 138.2. Break even is 11% of the recent move. 50% take profit is also 11% of the recent move. Full take profit, 22% of the recent move. And then for bonus, we will go in with other Fibonacci techniques like our retracement, expansion, projection, and also support and resistance, like we previously mentioned. You're going with your pullback as well as your overlap levels. Okay? So this really just for your reference, okay? It's not like you really have to stick to these levels. It's just if you're starting out and you don't know where to place your levels, you can just follow this guide. Okay, so here is the long example. Um, Here we have two Fibonacci techniques that we're using. Okay, firstly, it's a little bit hard to see, but we are firstly using a Nike tick. Okay, let me show you guys where the Nike tick is from here to here. Okay, and then we see price surpass the 100%. And then we see the 127.2%, or it looks like price is approaching it here. Okay, and then we go in with our projection. So our projection is from here. Projection uses 3 points, okay? So the starting point here, middle point here, and ending point here. Okay, and for projections, we use 3 levels, 61.8, 78.6, and 100%. So we see here that the 61.8 lines up with the 127.2 at this level here. Okay, so we can see that price reacted off of it nicely and shot back up. Okay, maybe another technique that I just want to briefly mention is our Fibonacci expansion. So for expansions, let me try and find it. We use the negative levels. Okay, we use the negative levels, minus 27.2 and minus 61.8. So for this, we look for the flash kind of shape like you can see here. And we can often use this Fibonacci expansion with your projection levels. So like I mentioned, the 3 points. The 3 points is your projection, and we normally can use that with the negative levels. So you can see here, the negative levels, we have minus 27.2 and minus 61.8. And you can see how price reacted off of the minus 61.8 really nicely. Okay, now we're going to talk a bit about trade management with Confluence. Okay, so a good habit is to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to areas of Fibonacci confluence, like we mentioned earlier. So if your stop loss is right before it instead of beyond it, you will likely get stopped out before the market reverses. Okay, so this is one of the reasons why people wonder why they get stopped right out before market starts to reverse, and then they start to complain about stop hunting. Take profit, on the other hand, you want to place it before a major confluence area. So when price reaches the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it because obviously we're expecting it to reverse. So instead of it reaching your profit target, it's likely to reverse back to your entry instead, or maybe even to your stop loss. Okay, so and then people will complain that the market is being manipulated because they missed their take profit by 1 pip. So here's an example of how you can place your stop loss and take profit, just to maximize your wins and minimize your losses. This is also on the forexarmy.com website, so you can go ahead and take a look after this webinar. Okay, Fibonacci confluence. So multiple Fibonacci retracement lines up together, so we know that this is what makes a proper Fibonacci confluence, and the example is over here. Okay, we have minus 27% Fibonacci expansion, as well as the 161.8 Fibonacci extension that all line up nicely here. Okay, so maybe just to break it down for you guys, the minus 27% Fibonacci expansion, we're looking for flash or lightning bolt kind of shape. So you can see that over here. Fibonacci projection, similarly, we are also looking for a flash shape. That's why I said these two can likely be used together normally. Okay, so you can also see it, see the lightning bolt shape. And then the 161.8 Fibonacci extension, this is our Nike tick strategy. You can see that the Nike tick is inverted in this case. Okay. Yeah, and you can see price bounced off of this level. Another example here, we have the 127.2% Fibonacci extension, right? So this is the extension, and it lines up with the 61.8% Fibonacci projection. So the 3 points over here. Another example, 100% Fibonacci projection. So you can see the 3 points once again is your projection. I think you guys can see the lightning bolt shape here. And then we use a 127.2% Fibonacci extension. So you can see the Nike tick shape. So what we are looking for is basically levels that kind of look like this. So as long as you have two levels that line up nicely. Okay, so we're combining Fibonacci methods again. In this example, Fibonacci expansion. So you can see the lightning bolt shape here. And we have a minus 61.8% and the 161.8% Nike tick. So you can see the tick here. Okay, and we are projecting it to reverse off of this confluence area here. Okay, so we would expect it, or rather we would project it to reverse off of the higher area, obviously only when price breaks out of this level here, which is why it's good for scalping, because then you can take these small movements pretty easily. Okay, another example here. Okay, the minus 27.2% Fibonacci expansion. This is once again the lightning bolt shape. You can see it really clearly here in this case. And then the 100% Fibonacci projection, also lightning bolt shape. And then the 127.2% is the Nike tick shape. So you can see it. It's inverted in this case, okay? And all of these three levels line up and we see price reverse off of this area. So it's attracted to these areas, but it's not likely to go beyond it. So it'll be attracted to it, it'll test this level, and then it'll reverse off. That's the kind of movement that we're looking for here. Okay. If we look at dynamic take profit and stop loss placement, okay, your swing high would be your stop loss in this case because we're expecting price to hit towards our take profit. So we're going in for a sell in this case. Okay, so take profit is your swing low resistance here. Entry is at this um swing low support that's turned into a pullback resistance level. Okay, and this level is also in line with the 78.6% Fibonacci retracement. So price hits our entry really nicely and reverses off of it and hits towards our take profit. Okay. Another example here. This is the same example, sorry. But in this case, I'm showing you guys that we have another Fibonacci retracement. No, this is a projection, sorry. So we have a projection here with a 78.6% that lines up nicely with our take profit. Okay. And then we see price just touched our take profit before reversing off of it. So this is why it's so important for you to know where to place your take profits and stop losses. Okay, because you can see here, it'll drop and then reverse off of it really quickly. So you have to be able to catch that touch before price reverses. And you can see it's really good that it touched nicely because it went straight to your stop loss after that. Another example here. Okay, we have price breaking out of the descending trend line. So since it's breaking out of it, it's giving us a bullish signal. And then we have this entry level. We have our entry level here, which is a significant level. You can see the number of times that price has tested it. And then you can see that we have a lot of Fibonacci levels that line out nicely. Okay, we have the minus 27.2 Fibonacci expansion, 127.2 Fibonacci extension as well. Okay, and these all line up with this level here, which we then make our take profit. So if I had placed my take profit above the confluence area, price actually reached it and reversed off of it. So it would have missed my take profit by a few pips. And it would have hit it straight to my stop loss. Okay, whereas if I had placed my take profit below the confluence area, price hits our take profit nicely before reversing back down. Okay. Okay, that's it for my slides. Let me know if you guys have any questions. Maybe just to summarize, the three scalping strategies that we went through today, okay, were the Nike tick, which is the last one that we went through, and then the retracement as well as the pullback. So basically, you can use all three together, and that's the best strategy is to combine all and form a confluence area so that you know which areas to look out for, and of course, know where to place your take profit and stop loss levels as well. Okay? Once again, if you have any questions after this webinar, feel free to check out forexarmy.com. Most of the information is there. How do we access previous sessions? I'm not sure if it's on YouTube. I think you can check YouTube first, the IronFX YouTube. But if it's not there, you can email IronFX. Okay, thanks so much, Wayne. Hope you learned something from this. Yeah, if you guys don't have questions, feel free to leave the session. Have a great rest of your week, and I will see you guys next week for um, our second part of this trade management series. And you can find me on LinkedIn if you want. Thanks, friend. See you guys next week.